Right, good morning or good afternoon, everybody. That's a good start. So good afternoon, everybody, to this session. I'm going to give people a few seconds to join. What I will ask everybody is if you've got any questions for Steve at Roma, please post into the Q&A session so that we can ask Steve towards the end of the presentation. So we'll give it a couple more minutes. So I'm Paul Hunt. I work for KnowledgeBank, and I'll be the host for this afternoon. So yeah, let me introduce Steve, and then we'll crack on. So Steve Smith is the National Sales Manager of Roma Finance. Roma are talking to us today about all things short term. So there's going to be a presentation which Steve will take us through, and he'll share his screen, and then after that presentation we'll open it up into Q&A. So if you've got any questions in the meantime during the presentation, feel free to post into the Q&A, and then we'll get to them at the end. I'm also going to run a poll now, so we can sort of gauge whether you've used Roma Finance before, and then we've got a couple of other polls as we go. So right, okay, so I'm going to run that poll now. But Steve, shall I hand over to you and sort of kick off the presentation?
Perfect. Thanks, Paul. Yeah, will do. I'll just share my screen now. And hopefully everybody can see that. Yeah, is everybody okay seeing that? We're all good to
Perfect.
go.
I can see that, Steve, so we're good to go.
Brilliant. Thanks, Paul. Okay, so as Paul said, I'm Steve Smith, the National Sales Manager of Roma. We are a short-term bridging and development funder. So I just want to talk a little bit. I'll go through this fairly quickly because I know we've got some questions at the end, and some of these things may answer some questions, so I can easily elucidate a little bit more at the back end of some questions. So welcome to Roma. So we've been going now for over 12 years, and we have a whole load of institutionalized funding behind us, as well as our own funds. So we have 10 funding lines in total. We employ very experienced people, and we are basically a people person company through and through. So that includes our customers. So borrowers, the most important people are our borrowers, and it is about them that we are interested rather than their products, what they're looking for, what they're buying. It's more about them. And it's definitely, we put them before the property. So you'll find that we fund land, we fund garages, we fund properties that are really run down, but the people behind it know what they're doing. And that's pretty much our ethos across the board. So we like to understand the borrower. So we like to get to know that borrower, so via the broker. So it's basically, what is the customer's motivation? What do they want? What's their background? What's their experience? Are their costs and timescales realistic? Especially now, remember, since sort of the whole Brexit and then COVID, costs and timescales are a little bit more stretched. Although, touch wood, I'm seeing that they are coming back around again now, but certainly for the last 6 months, there's been some delays there. And really their exit. As a bridging lender, we're always interested in what the exit is. And just to confirm, we do underwrite that person before the property. The property is really not that important to us, because obviously if we're lending them money, presumably, and they know what they're doing, that property will be worth a lot more money to them and us in the future. So that's the whole point really of our bridging and development properties. So what are our products? Well, we do residential bridging finance. We also do semi-commercial and commercial finance. We do auction finance. We also look at development finance, refurb finance, and we also have a 5-year midterm buy-to-let, holiday-let serviced accommodation product. But today I'm really focusing on the residential, semi-commercial and commercial bridging and development products that we have. So you're looking at 3 months to 24 months of funding. So our bridging ranges, it's cut into two. We have a Roma Prime and a Roma Plus. The Roma Prime is basically for people who've done it before. They've got 2 properties in the background and a good credit history, no arrears on any of their mortgages or loans. And with that, as you can see, our rates start from 0.6% and our loan to value goes up to 75% on those residential properties, 70% on semi-commercial and 65% on commercial. We look at loans from 100,000 to 3 million, but again, that's if you have a good 80, 90 grand deal, of course we'll look at it. If you have a really good 3.5 million deal, of course we'll look at it. It's a guide, and like with all these things that we put out on the marketplace. Roma Plus, just if they have got, their first time buyers and they have got some sketchy credit history, we'll still look at it. Rates are slightly tweaked. We'll still do up to 75%. And the loans we can do, as you can see there, from 75,000 to 3 million, especially for that first time buyer. It can be a smaller property at auction or whatever it can be to get them on the ladder. And we completely understand that. Now, the exciting thing at the moment is RomaFLOW. We're looking at RomaFLOW, and our RomaFLOW is basically a swift, fast channel for straightforward cases. So we touch it a lot less in underwriting. There's a lot more, there's no need for reduced documents. We do a lot more solicitor instructions. We do a lot more IT. So we have a dedicated underwriter and case processor for each case. We use technology for a streamlined process, and 80% of cases are completed in 28 days. Now we're looking at 15 days. If their solicitor is on the ball, we can do these cases in 15 days. There's very little we have to do on a RomaFLOW case. We've had the first few go through, they've gone through swimmingly, I'm pleased to say. And looking at a package side for the broker, what do we need for you for a RomaFLOW deal? A signed application form, a signed agreement principle, and either a valuation or an AVM, and that's it. We use the credit search and we use Credas, which basically does the ILA and the sort of KYC stuff for us, and that's it. So from a packaging point of view, it's really easy for you, and for us, it's really easy for us to actually go through quickly, and that is a big section. We've all seen with COVID that bridging and development has sort of delayed a little bit. It's not as quick as it used to be, and we've all blamed various things. Value is not going out, and there were genuine reasons with COVID that they wouldn't, and solicitors working from home and such like, and there were delays across the board in the marketplace, including ourselves, hands up. But with this RomaFLOW, we will bring speed very much back to the fore. And we came out of auction finance probably 12 years ago, and it was all about speed, and we're going back to that with a RomaFLOW. So please use us on that. Give us a try. Really, 15 to 28 days. It's a really good product. So our bridging criteria, very quickly, we lend in England, Wales and Scotland, not Northern Ireland before people ask, but certainly all parts of Scotland, not just Glasgow or Edinburgh. As you can see, I won't go through all those, we can go through those in questions, but you can see sort of basically what we do on residential property compared to semi-commercial and commercial. We can look at 100% funding options with additional securities. We also have a developer exit product available, and we title insure the legal process, which also means that it's a quick turnaround and a quick, fundamentally, a quick drawdown, which is the most important. Our refurbishment also use this. We're different from many of our competitors. We class light refurbishment up to 50% of the value of the property. So that could be a 200 grand house and £100,000 of works. We'll class that as a light refurb, and you get the rate accordingly. Medium then is 50 to 100% of the value, and we class heavy as at over 100% of the value of the property. We also do developments, and we do a lot of these. Probably our biggest growth area at the moment. Again, we're split between Roma Pro and Roma Dev. The Roma Pro for those experienced developers that have a couple of units already and have done it a couple of times before. Roma Dev will be for your first-time developers, which we do accept. So we can do for the existing and sort of very experienced people, we can do up to 12 units and up to £5 million. For first-time developers or people that are new to the market, we can do up to 6 units and up to £2 million. We do look at complicated cases, and we do look at non-perfect credit files. So you can see that loan to GDV is up to 65%, and we work backwards from there. So we're doing a lot of developments. It's probably our biggest growth area to date, and will probably continue to be so with the situation in the marketplace, with still not enough houses, still a small island with too many people. So we need to build houses, don't we? A quick look at development criteria. Again, we do full on ground up development in Scotland as well as England and Wales. We also use modern methods of construction, so things that are, and non-method, not just modern methods. We also do sort of, timber framed, steel framed. We do a lot of different things there. Again, going back to what I said earlier on, we look at the borrower first, not the property. Part built projects we love, no problem with part built projects. If other people have pulled out of it for whatever reason, COVID delays, etc., we can finish that off, not a problem. Developer exit is something that I want to develop more of. I think it's a great product that we're probably not using enough at the moment in the marketplace. Very quickly, we also do a buy-to-let, which is a 5-year term product, and that's on buy-to-lets, which is standard buy-to-lets or HMOs, as well as sort of holiday lets as well, and serviced accommodation, as you'll see. I don't want to talk too much about that because that's not what we're looking at today. So I'll flick through these. If you do want to talk to me after the event with questions, please do. And if you do want to send me emails or anything, we can talk about it forever to your heart's content, quite frankly. But for now, let's look at the bridging and development options. But just to let you know, we do a 5-year term product across the board on those buy-to-lets. A couple of case studies for you now. I always like a case study. I think it sort of gives a bit of flavour to people. So, for example, this one was a commercial to residential scheme. A lot of that going on, as I'm sure you're all aware. You'll see it this week in, week out. This person came to us. They bought 3 retail units, which were all a little bit run down, and they converted them, as you can see with the little pictures there, if you can see the pictures, to 3 terraced houses, and then 3 new build houses at the rear. So they created 6 properties, residential properties, from 3 fairly poor commercial units. Rental income on completion was 52,000 per year. And we got our money back very easily. It was a lovely deal. As you can see, the purchase price was 187, build costs were 332, so quite substantial. GDV was 990 though, as they've got 6 properties there, and the gross facilities that we provided was 473,000. So a day one advance plus the 100% of build costs. The 2 directors I knew actually a little bit myself as I did the deal. One was a builder, one was a plumber, so ideal. It was their first ever development for themselves, but they've done it many, many times for other people. So they're ideal customer for us, know exactly what they're doing, and they're making some profit themselves rather than for other people. It was a win-win all round really on that one. And then the second case study I want to provide for you was a purchase and renovation of a flat above a semi-commercial. Again, doing a lot of these. You see a lot of semi-commercial or commercial becoming semi-commercial. This one was a gross loan of 279. The total property value is 480, and the purchase price for the flat was 260, but it actually valued at 230, which again, you've seen a lot of that. You see valuations that come slightly down. Doesn't mean we can't do the deal. We can be flexible and actually get that deal done. The additional security is worth 250, which comprised of a commercial unit and warehouse. So again, we added that to it. As you can see from the pictures, excuse me. As you can see from the pictures, it looks a hell of a lot better now than it did at the start. And the commercial warehouse at the backyard is in the process of planning for 2 times semi-detached houses, which we will do again. So it'll be almost like a ground up development at the back of that. And again, with our borrowers, because we have a relationship with them, with our brokers and borrowers, we do like to do repeat business. Any repeat business, the broker gets the money and they get fully informed of. So again, we probably up to about 25-30% of businesses now repeat from borrowers. So you'd like to think that sort of says something about our customer service from front to back end there. And that's pretty much enough of me talking into a microphone. It'd be great to get some questions from you. It'd be great to be working with you. That's the general inquiries at. Obviously, I can provide you with my email address, which is steve.smith@romafinance.co.uk. I'm the national sales manager, so anywhere in the country that you are, I can put you in touch with our BDM in that area. We've got BDMs across the country in England, Scotland, and Wales. And that's pretty much me.
Thank you, Steve. Shall we stop sharing your screen? Actually, before you stop sharing your screen, we do have a question from Agnes, who's asked you to go back to the holiday let services accommodation slide. If you could sort of just, I know we're talking all things short term today, but a member of our audience has asked for that specific information. So would you mind sort of just going through that slide and explaining your proposition on that side of things?
Obviously, holiday lets have become increasingly popular due to COVID, haven't they? And with people not going abroad as much. So we've created this holiday let product. It's a 5-year term product. We do up to 70% loan to value from 75,000 to 500,000 per property. And again, we go on the holiday let if there's no income already. So if it's just a property that's being made into a holiday let for the first time, we go on what the valuer tells us the actual money will be raised during that year. So we use projected income from yourself, from other holiday lets in the area, and from the valuer. If obviously it's been a holiday let for many years before, we take on what it's done before. First time landlord is perfectly acceptable. They don't have to be a homeowner. That's, the product. Certainly if you've got any specific deal, just send it to me and we can have a conversation after this about it. But yeah, it's a product that we launched about a year and a half ago now, and it's done well.
Lovely, thank you, Steve, and Agnes. Hope that helps. Right, so Steve, I'm just going to close your sharing, and then we have a last question. But before we get into the questions, as I promised, we do have a second poll. So I'm going to run that now, and then whilst that's running, Steve, let's ask a couple of questions. So I've got a few from the audience in terms of the questions they sent in on registration. Plus, we've got a few questions live today. So let me do a couple that are live today, and then Steve, I'll also look at the ones that we've had in previously. So first question from an anonymous attendee. So do you have a different criteria for RomaFLOW versus Roma Prime?
No, the RomaFLOW is just basically speed. So it's basically if you've got a residential property that has one bullet loan, so a purchase at auction or a purchase from an estate agent or whatever, a private buyer, we'll put it through the RomaFLOW process. The actual, for the broker and the borrower, it's just a speedier process. You don't have to do anything different. You just have to package less. And actually there's less information that we need from it. It's all done with the magic of IT, really. So if they click through a credit search, they click through the CREDAS, they don't have to provide things like bank statements. They don't have to provide things like ID, because that's all done now automatically from IT.
Great, thank you, Steve. Well, let's go to one of the questions that we had earlier. So Michael Evans from Newable Finance, basically he said that one of the main barriers on using bridging is educating clients on the costs. So what would your advice be as to how brokers can help explain that?
I would always go keep it simple, because it can be made very confusing with the various costings with bridging and development finance. It's not, in essence. There's an arrangement fee, and then there's a monthly fee. For bridging, there's very rarely or shouldn't be an exit. For full-on ground-up development, there could be an exit, but it's quite simple. So if they're having a 6-month bridge, they have, and it's a 0.75% monthly rate. It's, they're charged that each month. So it's really keep it as simple as possible. Everything is usually rolled up within the actual bridge, apart from a valuation fee and a legal fee. So you can just keep it really simple. Just really specify an AIP from any funder, not just ourselves, should specify all of the rates, all of the amount really clearly. And if the customer's confused at all, take your time out, talk to me or one of my team, and we'll give you a full breakdown on interest costs of fees and everything else. And it's all on there. Although we're unregulated in our environment, we do treat the customer as a regulated customer and give them all the information they need. So it is fairly straightforward. It can seem like it's confusing with sort of pricing, but it's not really. It's very simple.
Great, thank you, Steve. I'm going to go to another anonymous attendee. There are people that have given their names, I promise. But we have another anonymous attendee. So the question is, does the LTGDV and or LTV include rolled up interest, e.g. 65% LTGDV on development? Does that include the rolled up interest?
No, so they'll be pleased to know, whoever the anonymous person is, it's 65% of LTGDV plus interest. So it's 65% net in essence.
Great, thank you. Right, we're going to go to another live attendee. So Carl Townsend has asked, what limitations do you place on first-time developers?
So first-time developers, there's none really. It's just the amount that we'll actually provide for them in funds. So it's sort of up to 2 million in essence for a first-time developer. With a first-time developer, I actually don't have a problem at all, because generally they have a very good builder or contractor that works for them who's done it before. So there's no real issue with a first-time developer at all. And it could be that they've done refurbs or flips before anyway. So we're quite open about first developer. We don't have restrictions on them apart from the amount that we will give them.
Great, that's really helpful, and that's a great segue into another question I have about flipping properties. So a lot of brokers on the registration, they ask about flipping properties and using bridging finance for auctions. So so any tips that you've got really for brokers, and as to one, how you work with that type of finance, but also anything from your experience as well?
I think to look at auction, it's a great way to get in. It's a great way to start. It's a great way for you to go for a flip. I think with any auction purchase, look at a property that is probably the worst property on a good street. I think that's probably the best way to look at it. It's all about the postcode. If the postcode's a decent postcode, but you need a bit of work on that property, it's always going to be worth it, because whatever work you put in, you'll get more money back when you sell it and flip it on. So I would say look at those. It is all about location. We're seeing the auctions, houses that a lot of people are having to pay more now, because, I suppose the stock is a little bit low right now in Britain. We haven't been building particularly successfully over the last 18 months. And I think a lot of auctions, a lot of people after the same properties, but there are bargains to be played out there. And I think just look at maybe properties that aren't particularly in a good state of repair right now, because they're the ones that you make money on when you actually do them up.
Cool. And the process in terms of a broker applying for a customer in terms of auction finance, what does that, what sort of information do you need? What sort of timescales are we talking about?
Yeah, sure. Well, that's ideal for our RomaFLOW product, to be fair. So if it's just literally they're going to buy it and then flip it on, you can do it through RomaFLOW. If it's going to be a heavier refurb, obviously we do it through our normal process, but either way we do an AIP. So they'd sign up an AIP that we provided for them, which is the quote with everything broken down on the fees, and then fill in an application form, which is very straightforward, same for any funder. And then basically, if it does fit into RomaFLOW, they don't need to do anything else, basically, apart from pay the val fee. If it doesn't fit into RomaFLOW for whatever reason, we would need ID, so passport, driving license, a proof of address, and potentially bank statements if there was some issues with credit. If there weren't any issues with credit, we wouldn't need those bank statements. But it is pretty much that simple now. There's nothing, we're not after a huge list of things on a simple bridge that's going to be flipped.
Right, that's really, really helpful. Okay, I'm going to go to a couple more questions. So Mandy Wabi from Veracity Financial Planning, she basically asked us to sort of cover criteria, speed, number writing in today's session, which I think you've done in terms of the presentation. But again, going back to costs, timing, and valuations can be a barrier from a bridging perspective. So obviously, so what's Roma's views on those issues?
Okay, I think if we take valuations first, I think valuations, yes, during COVID at the peak, there were some issues with speed. There were, they had to sort of, some values wouldn't go in if the people were there. Some valuers, needed more time to do a valuation, which is perfectly natural. That's sort of calmed down now, to be fair. We're not seeing any kind of delays on valuations now. We have brought in AVMs. So again, if we can do an AVM, so if it is a, you know, it ticks the box on that, that makes it a lot easier, that makes it quicker again. So valuations are not really an issue now. They were, granted, during COVID, but I think that's fine. On costs, again, really, it's just being really honest with your borrower. It's like, if you can do a quick flip in 3-4 months, it's not going to be very costly. You know, your 0.75 or whatever the rate might be times 3 or 4 months. You know, it's easy to work out. The longer you take that bridge for, the more expensive it is. So, you know, if they can do it swiftly, not really an issue. And costs, I think it's part of. I've got a couple of, you know, buy-to-lets myself. You use a bridge because you have to, because it's an unmortgageable property that you're buying, you know, at the end of the day. So if you can do it quick and make it mortgageable as quickly as possible, it's a very good use of a bridge.
That's really helpful. Next question, one from Carl Townsend at JMS Financial, another one from our registrations, and he asked, you know, semi-commercial sort of bridging, is that something that you do? And also, you know, in terms of, is there anything more from your proposition, your criteria, that you should be aware of on the semi-commercial side?
We see a lot of semi-commercial stuff and a lot of commercial that becomes semi-commercial, to be fair, as people want those rental incomes on sort of, you know, a buy-to-let, as opposed to using the office upstairs as an office or a storeroom or whatever. So they're using, you know, sensible. We do semi-commercial. We do 70% loan to value on semi-commercial properties. And again, there's a lot of them out there. If you think of all the standard estates around the country, they all have that newsagent, estate agent, post office sort of like stretch, don't they, on every other street corner. So there's a lot of those. A lot of those are turned into semi-commercial. And we do a lot of that. As far as a bridge and sort of flipping it, or sort of doing a light refurb or medium refurb on it, it's the same kind of system as a residential property. There's no real issues to worry about. It's really access, I would say, when you do the exit to a term loan. You just make sure the exit is not through the actual shop, because a lot of exit funders won't like that. It has to have a separate sort of entrance.
Gotcha. Okay, thank you. Thanks, Steve. Right, we'll go to a question Richard Butler has asked on the Q&A. So this is really placing the case live. So no pressure. No pressure, Steve, on this one. So how about a buy-to-let property to an expat living in Dubai? They don't own a property in the UK, but wants a buy-to-let in the UK.
So we could do it, but the issue you have there is that because they're in Dubai, they would have to come over for the KYC part with a UK solicitor. If they did have properties in the UK already and knew a UK solicitor who would vouch for them, they wouldn't have to. But if they've got no footprint, we can do the deal, not a problem, but they would have to come over to a UK solicitor and be actually seen for who they are, go through the usual know your customer and AML, so that we can, once they've done that once, obviously we can do their second, third, fourth without them coming back. But so we could do the deal, but they would have to come over and see a UK solicitor.
Right. Thanks, Steve. Well, so you'll get those sort of questions sort of through when we sort of speak to you later. So hopefully you sort of follow that one up with them sort of after the event. So a couple of other questions. Rory O'Mara from Closed Bridging Finance has asked about what's the difference between refurb and development finance, and how would you define it? Because I know so different lenders have slightly different rules.
Sure, we all do. We're all slightly different, just to confuse brokers, really. But the way I look at it is development is a ground up. So if you are going to buy a property and level it and then start again and build something, that's a development. Or if you're buying some land and developing, that is a development. If there's a property there that you're going to use as a shell and you're going to do a light refurb or a medium refurb or a heavy refurb, that is classed as a bridge. So you have a bridge refurb, which is the property is going to remain, and a development is if you're either going to knock it down and start from scratch, or you're going to literally buy some land and start from scratch and put the footings in. That's the difference.
Great, thanks, Steve. Agnes has asked for she's got another question. So on the bridging side, the short list of packaging requirements, so has left her wondering, do you not need proof of income, proof of deposit, etc.?
So if they are just doing a simple bridge and they are not going to service it, so the interest is deducted, we wouldn't need any proof of income. Proof of deposit will be just questioned by a solicitor at the end. We wouldn't need anything up front. So the proof of deposit would just be a simple solicitor to solicitor conversation. But if they were going to service it, we would want to see some proof of income. If they're not going to service it and the interest is deducted or rolled up with a development, we wouldn't need to see any income.
Great, thank you, Steve. Okay, we had a few brokers again on the registration say that finding clients and identifying opportunities for bridging can be difficult. So how would you, with your experience and obviously you've got Roma's experience as well, how would you sort of help brokers and to sort of uncover opportunities for bridging?
Yeah, well, bridging can be done for many reasons. It's not just to sort of purchase an auction property, resi, and then flip it on or keep it as a buy-to-let or whatever. There are many things. Anything that's unmortgageable currently, so something where it's got some issues, got damp, it's got somebody can't get a mortgage, then we can give them a bridge, do the works, then they can flip it to a mortgage. So there's probably a lot of those. So it's probably having conversations with estate agents, conversation with auction houses, even conversations with accountants, all of these kind of soft introducers, if you like, rather than a broker. And I was a broker myself for 7 years, so it's how I got a lot of my business. It's really knowing your own sort of personal patch, where you are, and sort of knowing the people that deal with things. Estate agents are great to get to know. You'll have lettings agents and estate agents especially, and you'll see there where people are struggling to get a mortgage because of things like, well, actually you could have, even for 3 months, get a bridge in there, get the property off the market, do it up, and then they can move on to a mortgage. So don't just think it's something that, it's got to be at an auction house or whatever. There's many commercial, semi-commercial properties that need a bridge to sort of get to where they need to be.
Great. No, that's really helpful. Right, we've got a couple of extra questions on the Q&A. So, do you do second charge bridging?
We don't do second charge per se. We'll do second charge bridging to get a bridge. So if the person doesn't have a deposit to purchase a property, we'll use a second charge to assist them to do that. That's fine. We don't like to just do second charge loans full stop. It's not our bag. There are a few funders out there, but we'll use a second charge where it's needed, where they haven't got quite the deposit or no deposit, and we'll use that as a charge to get them the property. But it's more sort of a help rather than a standalone product for us.
Great, thank you, and thanks for the question, Goldberg, as well. I forgot to name check you when I read out the question. We got another question here from Saraj Palmer from Perfect Financial Services. And I think we've seen this actually. We've had this question a few times when we've run webinars on bridging. Simply, how is bridging finance calculated?
And it is very simple. It's just you look at the amount of months you've got in that bridge or development, and you add the rate that you have times those months. So basically, there is compound. Obviously, it does compound up, but for that person, I can send them I have a beautiful Excel spreadsheet that they can put in any kind of amount of money, any kind of term. They can pay off part payments, and it will calculate the interest to the nth degree. It is simple. In essence, a normal bridge is very simple. If you take it for 9 months, it's 0.6 or whatever it is per month. You can work it out very easily. But obviously with development funds, when it's in arrears, they're drawing down funds in month 6, month 7, month 9 at different amounts. It can get quite convoluted. So I have this lovely spreadsheet, and I will certainly send it to that. He will have hours of fun with it, I'm sure. He can put in anything and you'll get to the penny on it. So just as I say, contact me after the event, or I'll talk to you, Paul, and get that sorted. I can get him that spreadsheet, no problem.
Not a problem. And obviously there's sort of different ways that interest can be calculated as well on bridges. So is it worth sort of covering sort of that as an overview?
Yeah. I think the biggest difference for us is on your sort of tranche drawdowns. So whether it's a refurb or a development, you only pay interest on ours for the amount you borrow for how long you borrow. So if it is a tranche drawdown of 500,000 over 12 months, you don't pay 12 months interest on 500,000. You pay the interest for how long each tranche has been drawn down and for how much. So if they draw down 100,000 month 3, you obviously pay 9 months on that one, but on the 12-month term. If they come down another 100,000 on month 6, it would be 6 months interest on the second one of 6 months. And so it's a much easier. You can make a huge saving by looking at that. And again, it's probably something that needs to be highlighted a lot more, to be fair, in our industry, because for people who just charge 12 months day one, it can be a massive difference when you're talking £1 million development compared to paying it every time they take a drawdown for each part that they take a drawdown of. So it is significant. There are certain ways. Again, it should all be highlighted on your AIP from whichever funder you go to. It's highlighted on ours. We can also give you on ours a drawdown system where it shows you exactly how much interest they'll charge. We have to make some assumptions because you don't know when they're necessarily going to take every single amount, but we can make some assumptions. Say, well, if they took 250 month 3, 250 month 6, 250 month 9, and 250 month 12, this is the interest they will pay on this. So we can give them that upfront before they sign anything at all.
Fantastic, thank you, Steve. A couple of other questions. We've got another case to place, excitingly. So Carl Townsend has asked, first-time landlord wants to buy his parents' home on the buy-to-let. He used to live at the property and he's not a homeowner. His parents are over 80 years old and want to move back to their country of origin.
Okay. Yeah, I mean, you have to be careful of regulation in that situation, but if it's a limited company that you're going to do the actual deal in, that's fine. That equates for that. It's a business thing. Was he looking to live in it or is he not looking to live in it is the question. If he's looking to use it as a buy-to-let going forward and he does it in a limited company, we're fine. If he's looking to live in it, obviously we couldn't. That would still be classed as regulated.
Great, thank you. Right, we've got another question from Russell Sanders. Now he's asking, with the exception of the rolled up interest, what are the other costs a client will typically incur for a bridge? Lender fees, survey fee, lender solicitors fees, etc.
Yeah, so exactly that. You have a valuation fee and a legal fee. You also then have an arrangement fee, which is generally the commission, to be honest, for the broker. And then you have the rate per month. And then if it's a full-on development ground up, you may have an exit fee as well. But they're the fees you've got, basically. And they're the fees for every funder, in essence.
And actually, a question just from me, actually. The valuation fees, are they substantially different to the valuation fees that you would see in a normal sort of resi buy-to-let case? How do they differ?
If it's a light refurb or just a purchase, they're exactly the same. So they're quite, for example, if it's a £200,000 property that you're just going to purchase and do a very paint and sort of little bit on, you're talking about £400. So it's very cheap. Excuse me. If, however, it's a development, it's obviously a much more expensive valuation because they have to look at the GDV, they have to look at what you're actually proposing to do. So for a 200,000, that could be £1,000 compared to a very simple £400. It just depends what the actual deal is. But if it's a simple like refurb and flip or purchase, they're very similar in prices to a very standard valuation. It's only when you get to a GDV where you need to know the future value of what you're actually building and look at sort of your sort of plans, your cost of works, etc. It gets more expensive.
Gotcha, thank you. Another question, actually, just again, looking at some of the registration. So there's a load of talk about permitted development. And I suppose a really quick overview. What does it mean? What are the opportunities and how can Roma help?
Huge opportunities. The government has sort of said they will make it easier to build and develop within reason. And if it's within permitted development, absolutely fine. You can do it straight away with us, not a problem. It saves you getting that planning permission, which can be tiresome, sometimes very long. Sometimes you have to go through a lot of hoops. But yeah, if it's got permitted development, and we know it has with the various sort of councils. It's different, sadly, in every area of the country, which just, you know, is one of those things. But if it has permitted development, absolutely great. You can just crack on and go for it, which is lovely. It makes things a lot easier.
And in terms of from a lending perspective, it's, you know, relatively straightforward.
Yeah, absolutely. It's, you know, it's like having full planning. You know, you can just go straight into it, so not a problem at all.
Great. Okay, we've got another question. Actually, I suppose sort of similar, in a similar vein. We had a few questions from people on registration asking whether bridging can be used for extended leases, purchasing freeholds, etc. Which I'm assuming it can, but I suppose it's all about the exit, isn't it?
Well, that's my answer, really, Paul. To be honest, of course it can, but we need to know what that exit is. I mean, you know, so as long as the exit, you know, counters for that, that's absolutely fine. But yes, it can be. Of course, it can. Great
stuff. Right, okay. Well, look, we're kind of, what I will do is I'm just going to run this poll to just see whether today's session has been useful. But whilst people are sort of filling that poll, Steve, have you sort of got any sort of final points that you want to sort of get across to the audience in terms of, I suppose, the opportunities in bridging and also, you know, and also Roma?
Well, I think that it's huge opportunities at the moment. I mean, we've literally just had our best ever month in drawdowns in 12 years. So, you know, COVID is, regardless of everything, touch wood, seems to have gone away as far as, you know, bridging and development is concerned. We're having much more positive signals as well from actually sort of the price of materials and the time materials are taking to come into the country. That's actually getting better. We're seeing a lot more drawdown requirements from our customers, which means they're actually getting the materials now, where there was a problem before with timber and steel and such like. So it's a positive world. There's a lot of bridging and development out there. There's a lot of funders as well for your brokers. So find the right funder for you. There's plenty of development and bridging funders. For us, we do a lot on, because we class light refurbs up to 50%. That's a big opportunity for a borrower because a lot of our competitors don't. We do first-time developments. A lot of our competitors don't. And RomaFLOW will speed up the process for your very basic bridging. So give that a go as well, because we've seen probably the biggest issue with bridging over the last 2 years is that we've seen those, used to always be 28 days, not a problem, Paul, but that sort of started creeping into 30, even 40. And now it's like bringing it back down to actually a bridge for an auction should be 15 to 21 days. Let's be honest. There's not a lot, you know, that needs to be done on that, and that's what we're getting it back to you. And with the less packaging for the broker as well, it's easier for all parties. So hopefully that's, you know, our way to continue doing very well in this market.
Fantastic. No, that's really helpful. Look, I think look, we've exhausted all the questions from the team. So look, it's really sort of a quick thing for me to say thank you for everyone that's attended today. We hope it's been useful, and we'll sort of pass Steve's sort of details over to you all post event for you to make contact. Steve, really appreciate the session, really appreciate the time, and like I said, I hope hopefully it's been useful to everybody. So thank you.
Well, thank you. No, it's been great.
No problem. Cheers. Bye bye.
Cheers. Take care. Bye now.